All right,
All right.
well, we're back for the
Well,
weekly roundup. We got Matt Dines here from the build team, Dave and Cameron as well. It's been a week. Things are happening. Should we dive right in?
yeah, while you were doing technical difficulties on your PC, we had Amazon earnings beat, soft on cloud. I think I need to dig into it, but they were down, I think 7%, recovered now down 2%. So action packed. I think
All
we kind of
right.
have a short one this week. So yeah, Matt, why don't you just jump in?
Yep. So where we left off last week, Cameron, I remember we were talking about fallout from DeepSeek, how we saw upside for AI native software development to slowly trickle in. We have some headlines around that. So I noticed on one AI tool that my favorite kind of text-based search, GPT type tool, Perplexity.ai, announced that they flipped over from I think it was o, OpenAI's O1 model on the back end to the DeepSeek parameter set. So that just kind of jives with what we expected last week. With the incentives, you can shift your cost structure down for your inference costs, training costs, but basically from your variable cost standpoint against all your competitors, um, you have to move and cut costs. So then the follow up step from that, Cameron, you saw this week, Gemini announced their price cuts. So um, really big developments for the overall AI trend. That'll be an interesting one to continue to watch. But the big news or the big action is happening outside of kind of the AI and tech trend with what we've seen in rates markets, um, FX, currencies, and then the tariff situation as that continues to evolve and move ahead. But where I wanted to start off this week, we won't start off with the front end, bills, money markets, etc. That one's still in wait and see mode, as we expected mid-Feb, before anything really starts to pick up steam there, as Chinese New Year comes to a close, tax day starts to come into the horizon, with about 2.5 months left on the clock. So front end, I'm not going to start there. I want to start in long ends, but not in the market you'd expect. We'll get to the U.S. Treasury, but first I want to start with um, just built off that. But to start with, like I think that's a good case study for this idea that you can just keep terming and tapping further out. Like if you have to keep doing that, you're going to be raising like the UK government, His Majesty's Treasury. We don't say her anymore after transition to the King Charles, but they owe that's £100 like a par in 2053, and they're getting 47 pounds today. So and they owe technically it's a 1.5 coupon, but the yield on that is 4.9, and their economy is not growing. So a lot of things to unpack there, but what you're seeing is, I mean, if you're looking at a GDP that's not growing, it's stagnant, and a high cost of debt, nearly 5, and then you keep tapping that long-term issue, and it's like, that's a bad setup. Like that's a bad sign. It's not where you want to be. I'm glad to say, we can talk about it, but the U.S. is in a, I know we can, there's a lot of fiscal problems in the U.S., and there's a lot going on this week to address them, but you would much rather any day of the week be in the situation in the U.S. than do what a government like the U.K. or a lot of governments in Europe are facing to fund themselves. So that's why I started with the U.K. Thought it was
But
an interesting development.
I mean, people still want. You said the auction went well, though. I mean, people still want this debt. I mean, who's holding this?
Relatively well. Who's holding this? So you're okay. This is where who do you get to hold your currency IOUs? To buy this long-term bond, your best bet, like so to buy a bond yielding 4.9, inflation's 2.5, but growth is 0. Like if you think about that long-term rate, has to be growth plus inflation. Essentially, that's all there is. Who do you get to hold that? Like your first choice would be other, like participants who have British pound denominated debt, right? So if you hold debt obligations that were built up over the 2010s and the COVID bottom, if you want to kind of neutralize that, asset liability management, that's where it would be. Like I wouldn't be, but when I say I'll speak for me individually, or for firm accounts, etc. Like we're not going out there trying to buy UK government debt. Like it is just a very weak situation. This is not where purchasing power gains are likely to accrue, like capital appreciation. So it's probably going to start within the debts, like the debt obligations or debtors within the who are already British pound denominated. So financial system, pensions, etc. That's where the funding is going to come from. But on to the U.S. situation, there was a ton of All right, no questions there? All right, so some deep
we're just entering a period of loosening financial condition, less regulation, less government spending, rates potentially coming in. What's counterbalancing that? Tariffs, price of eggs, commodities, like what's the, where are we, where does this end up a year from now?
So I wouldn't say it's going to be a free for all on when you say it's like looser regulation. A lot of it too is just better regulation. Like use one example, SAB 121, right? Prior standard was to get involved if the banking system or a qualified custodian wanted to get involved with, say, custodying Bitcoin for a client, you had to hold capital in reserve 1-to-1 against an extremely volatile asset to begin with. It didn't work. And what effectively was the result was the institution or the legacy players couldn't adopt or come into contact with Bitcoin in any way. Say crypto too, but they don't matter. And so what you effectively get out of that is a stalemate. Like the Bitcoin firms can't access dollar capital, can't grow. Traditional, like the legacy firms, can't tap this new growth market to fix their own, or grow out of their own stagnancy problems. So I'd say a lot of it is just better regulation. Where does this go in the long term? Well, a lot could change by the end of Q3, Q4. Like we talked about stability on the long-term issuance. Like I'm expecting kind of a steady, just operating, steady waves, if you will, for the next 2 to 3 quarters for Treasury borrowing condition. Like tax receipts should be good coming in April after a really strong year across every asset class and returns for 2024. But if we start to see risk assets draw down or give back, front end yields are going to come in, is the most likely expectations. Even though the Fed held for a meeting, they may continue to hold for a couple of meetings, but the expectation is there's still more rate cuts coming. They're just going to be stretched out a little bit. Those will come. Now what's going to happen is that's going to be positive for the Treasury, lower interest payments on the front end, positive for credit creation, right? Because all of your short-term, everything on the front end of the yield curve as rate cuts start to come in, anything that was issued in the last 2-3 years is probably a higher coupon than the new stuff that's going to be coming out in 2025, 2026. So all of that stuff gets marked up. Your balance sheets look healthy. Your longer term rates, 10-year, 30-year, like all of your consumer borrowing that's anchored or indexed to 10-year, assuming you can get the private sector to go out and lever itself up or take on credit, you do have a recipe for this thing to grow, the U.S. economy to grow, or the dollar, domestic dollar economy to grow in the, let's call it 2 to 3 year horizon. Now, in between now and that thing happening, that next wave up, is there some sort of a pullback, correction in risk assets? Could be, and then that could, how we navigate that, you don't know until you get into it. Really tells you what things look like, even by the end of this year. So it's hard to see, 1 year forward, how this is going to go. But if it goes well, what you'll see is front end, you're going to get those last 50, 100 bips of rate cuts. I think Mark calls it 50, 75 as expectations. The Goldman Sachs quick poll survey today came through, and one of the callouts, I didn't put this in a slide, but Fed funds for end of the year, half of the group sees it above 3. This is for professional money managers. Half of the group sees terminal rate or Fed funds rate at the end of the year at 3% or above. Half of it sees 3% or below. So just based on that expectations, probably a lot of players expect rates to come in further on the front end than the expectation. Some of them just see a few more cuts, but bottom line is they're going to be lower still. There's still more cuts to go. Long end, part of the commentary from Bessent, Trump, etc. yesterday was a focus on the 10-year rate, not necessarily the Fed funds rate. But between those two things, all you need to see is a positive sloped yield curve for this thing to incentivize growth in the U.S. economy. And so the fact that we're coming out of a situation where you've got so much of the issuance loaded up at the front of the yield curve, that's the stuff that we know is going to cut the, like, that's where we know with more, higher probability, higher certainty that those rates are going to come in. So all of those IOUs get marked up. It's going to be healthier for bank and financial institutions' balance sheets. And so, assuming there's growth or demand to take on debt and lever up, which really amounts to jobs, are people employed, right? That kind of tells you where this thing is in 12, 18 months. But I think things we go into 2026 should be looking fine, looking good in my opinion, is how I expect it. One of the things I want to talk But Cameron, I know we got to hop. I got an appointment I got to get to. Didn't let David Cameron get to chime in as much, but next week we'll pick it up and talk more about AI, the bigger trends, and some of the things we didn't get to this week. Any final thoughts, Cameron? Anything I missed?
No, I think the regulatory piece is something that I was going to touch on, but that's critical. There's been some updates even as of today. You can just click through those. Actually, go back 1, 2 slides there. This one, I think